Well, ladies and gentlemen, thanks very much for the opportunity to be here today, and to say that I'm amongst an esteemed company would be an understatement. It's also nice to be amongst friends of the mining industry, and as a West Australian coming to the Eastern States, that's not usually the case. So I do appreciate the chance to be talking amongst friends today. And when I think about, I grew up in Sydney actually. I did all of my schooling years here. And perhaps as a result have a little bit of a unique perspective about life in the West and the state of knowledge here in Sydney, Eastern States generally, about the mining industry. Now fortunately, as I grew up, my mum and dad are actually from Kalgoorlie. So somewhat a unique experience living in Sydney, but having strong ties back to the centre of the mining universe in its day in Kalgoorlie. And I can appreciate how hard it is for people in the Eastern States generally, notwithstanding present company of course, understanding the mining industry. Thanks very much to the Mining Club for doing a good job in promoting mining in Sydney. And of course, thanks to all those sponsors that are intimately involved. All right, kick off, and here the disclaimer is just basically saying that from here you can't believe anything that I say. And on that note, we'll kick off. So Atlas is a minnow in the iron ore industry, which of course is dominated by the global majors. We refer to them as sharks, and we have some other names for them as well. But we've got a fantastic niche in the iron ore game. And today, it's centred around what we call our Horizon 1 of growth. And the picture there, it paints 1,000 words. Basically, our strategy, in its most simple form, was to develop iron ore mines, explore and develop iron ore mines close enough to the port of Port Hedland that we could develop them independent of access to other people's infrastructure. So within that ellipsoid there, described as Horizon 1, our mining operations, of which there are 3 today, are within roughly 100 kilometres of the port. And the opportunity was to develop those mines based on a trucking operation. And therefore, we were able to maintain our independence in terms of accessing other people's infrastructure. And our observation of the industry when we first started down this path was that if you were going to fight for access to other people's infrastructure, that was going to be a very lonely, hard road to hoe. So we said, let's row our own boat, and today we have an amazingly successful business, and I'm going to outline how that works. Of course, we also have some fantastic options for future growth in our Horizon 2 of growth. And our big footprint in the Pilbara, we've got 1 billion tonnes in resources in the Pilbara. We've built that within 6 years, provides an amazing platform to continue to grow the company's activity. And we look forward to delivering into that over time. But as we centre in on the operations that are close to the port, again, that area that we call our Horizon 1 of growth, in the picture on the right-hand side of the slide there, we've centred in on what are our existing mining operations, being Pardue, Wodgina and Mount Dove, and soon to be developed mines at Abydos and Mount Webber. And today we have 3 mines in operation, producing between roughly 6 and 8 million tonnes per annum. In fact, with the full commissioning of our Mount Dove mine at the end of this month, we'll be running our Pilbara operations based on that simple trucking model at 8 million tonnes per annum. And it's a fantastic business. And at today's prices, we are making a decent buck. Having said that, of course, we're reinvesting heavily in the business to continue to grow. They are simple mining operations. A couple of key strategic levers, of course, the trucking operation. Now, don't imagine for a second the trucks that you guys would see on the highways here or on the freeway. They're not your average truck. They're what's called a quad configuration road train. And they're a prime mover with basically 3.5 trailers running on the National Highway Network. They're a street legal truck, but they run under a regulated regime through the West Australian Government called the Concessional Loading Scheme. And a lot of people said to us, particularly in the early days of Atlas's development, how can you run an iron ore business based on a trucking model? It just doesn't seem reasonable. Well, today I can pleasantly say that we've proved all the doubters wrong, and we have run an 8 million tonne per annum business using a trucking model. And it's a question, why does it work? So it's a question of horses for courses. In rough terms, today we pay for every tonne that we haul about 10 cents per kilometre haul, per tonne per kilometre haul. So if you said on average our mines were 100 kilometres from the port, it's implied our trucking cost is $10 a tonne. Now you compare that to rail. If we were to access a third-party rail regime, I reckon the typical going rate today would be about, let's say for argument's sake of simple maths, 5 cents per tonne kilometre, half the cost. But if you're 400 kilometres away from the port, it is still costing you $20 a tonne to haul your ore to the port. So the maths is pretty simple. If you're running at the scale of operations like Atlas is today, with more growth to come, then you don't want to be spending billions of dollars on a railway. Pay the 10 cents per tonne kilometre and you've got a successful business. And not only that, you're not constrained in your ability to start mines and to continue to grow. It makes a great business. Some other things that contribute to our mining operations, they're low strip ratio, typically less than 2.5 to 1. And in the Pilbara, there's no doubt that's a competitive advantage. It's direct shipping ore. Direct shipping ore means it's ore delivered to a ship exactly as it's mined in the ground. All that we've done is we've crushed it and we've screened it. There's no additional processing. And again, being a direct ship ore, that contributes to a relatively low cost base. I've talked about the trucking model, and there's no doubt about it. It's a success. And the last key strategic lever that Atlas brought to the table was recognising very early that the port was always going to be key to the continued growth of the business. And as a result, from the very early days in our iron ore strategy, we locked in port capacity. And today, we have access to 15 million tonnes per annum of constructed port capacity, the berth, the ship loader, it's all there. And Atlas has an allocation of 15 million tonnes per annum to continue to support the near-term growth of the company. Not only that, we've managed to put our foot on expanded port capacity in Port Hedland Harbour, and that's like gold. Because Port Hedland Harbour these days is a very, very busy port. And it's now, in essence, fully sold. There is no more port capacity available. And Atlas, in total, has 46.5 million tonnes per annum of allocated channel capacity, and that is an amazing strategic lever for Atlas to continue to keep growing. Here's a bit about what's been happening in the business of late. We're in the process of ramping up our mine capacity. During the 2012 financial year, we shipped 5.6 million tonnes. Today, we're shipping at a rate between about 6 and 7 million tonnes per annum, and as I said, once we've finished commissioning at the Mount Dove mine, we'll be running at 8 million tonnes per annum from the end of this month. And you can see the evidence in the tonnes mined, tonnes processed and tonnes shipped. We're on the up. In fact, we've had a cracking start to the new financial year, and the mine operations team's done an amazing job continuing to grow our production base. It's going to reflect a bit about where Atlas has come from. As a junior mining company, successful mining companies are very, very rare. I couldn't tell you the exact stats, but if I had to guess, I would say one exploration company, roughly, out of 100, makes it to a position where they've not only started a single mine, but have subsequently opened up multiple mines. And of course, as we sit here today, Atlas sits into that category. And the reason it happens is that people are prepared, in investment terms, people are prepared to put their capital at risk to realise extraordinary returns as and when they become available. But of course, people are not going to make those investment risks in the event that they have the potential for extraordinary returns taken out of their hands. And that's a theme I'm going to come back to a little bit later in the presentation. So we started as Atlas Gold. Like every good mining company, you've got to be called something. We called ourselves Atlas Gold. And those of you that know David Flanagan, our chairman, would appreciate that if anyone was going to be successful, actually, it was going to be him, because he has worked incredibly hard and with a passion that is unbelievable to continue to drive the success of the company. As the founding managing director, he raised the money. He was the only employee. But of course, by 2008, we'd started our first mine. Do you know it cost us $13 million to start our first mine, the Pardue iron ore mine? That would have to be the world's, if not Australia's, the world's cheapest iron ore mine to start. And when the iron ore price hit $180 a tonne, we were basically paying that back every 3 weeks. But it doesn't happen through lack of effort. And of course that's a tribute to David, because in essence he was the driving force. So at that time in 2008, actually there's a story worth reflecting on there, right in the guts of the GFC, the board, the mining fleet was on site, and Lehman Brothers had just collapsed, September 2008. And our trading partner had walked. They weren't going to buy the iron ore. And the board was faced with a question. Are we actually going to start the mine? To their credit, they did. And they were prepared to start because ultimately it was a relatively low-cost development, being $13 million. And Atlas had a significant, for a company of its size, it had absolute strength in its balance sheet, roughly $100 million in cash. And they said if ever there was a chance to make it successful, we should give it a go. And in September 2008, with our trading partner having walked, we had no one to sell our iron ore to, and we went to China, as you do. And we quite literally walked the streets to sell our iron ore. And in December of 2008, we made our first sale. And I think from memory, it might have broken some records actually for the lowest grade having left the Pilbara, because I reckon it was about 54% iron or something. But it was our first sale, and it was the start of the making of the company. Because of course, from there, from March 2009, you guys know, the rest is history. The iron ore price only went in one direction, and it was proven to be the right thing to do, to maintain a strong balance sheet, to continue to focus on the things that we do well, developing mines and selling iron ore. Now there's another reason why the global financial crisis, in a masochistic kind of way, it was actually good for us. Because what happened in that period of time was the benchmark system, well, if it hadn't fallen over then, it was certainly starting to fall over. The big mills walked away from their contracts with the major miners. And as a result of that, the spot market all of a sudden became liquid in a way that it hadn't been historically. And of course now that liquidity has gone on from strength to strength. I'm going to come back to that theme as well. The benefit in that for Atlas was that there was a whole swathe of steel mills in China who couldn't secure supply. They were being, pardon the French, screwed over by the big mills in China who was on-selling cheap benchmark ore at exorbitant prices in China on in effect, the spot market in China. But as a result of the benchmark system breaking down, all of a sudden those customers, mid-tier, lesser mills, quite often the private steel mills, had the opportunity for the first time to genuinely participate in seaborne trade. Now as Atlas, being a new supplier and walking the pavement selling the iron ore, we found all of a sudden there was this customer base that had not been served well. And I'm proud to say that those customers today are often the customers that are still with us and growing with us. And I've got to say, it is a burgeoning market. Our iron ore, not particularly large in production terms, would have gone to 30 different mills in China. that generally fit the category mid-tier, lesser mills, quite often in the majority private mills. They're buying our ore and they're happy to participate in continued sales. I'm going to come back to sales a little bit later on. 2010, our second mine. 2012, our third mine. Today, 300 employees, and that's direct Atlas employees, but easily another 300 of full-time contractors in and around the business, mining, crushing and screening, haulage, or for that matter, some of our feasibility works as we continue to look to expand the company's production. 8 million tonnes per annum by the end of this month, 10 million tonnes per annum with our fourth mine, Abydos, in 2013, June, and 12 million tonnes per annum by December 2013. And as I said, it all makes for good business. We've been very active in the last 3 months or so to continue to secure finance so that we can continue to support our Horizon 1 of growth. And I'm proud to say that we've secured this Term Loan B facility from the bond market in the US. Importantly, it's a very flexible source of funding. It has no ongoing earnings covenants, and clearly that's important in an environment where you think that there is increased volatility in iron ore markets. We're funding the business to continue to support the development, but of course to also maintain liquidity in the business in the event that there is more volatility. And you'd have to say that's conceivable, particularly with the volume that's now priced against spot indices in China. As a result of that funding, we're building Mount Dove, nearly complete. We're in construction at Abydos. It'll be finished in May next year and at full speed by June 2013. The Mount Webber mine will be constructed largely in the second half of next year, and it'll be subject to a board decision in the first quarter of 2013. And we're also expanding our port footprint and the stockyards within which we work adjacent to the existing Utah Point berth and ship loader. And as a result of this facility, we're now fully funded to continue to support that growth that's all important to us. Just a quick slide just explaining how the mine production unfolds. We've started 3 mines in 4 years. It's no mean feat. And they're not easy. There's been a bit of blood, sweat and tears. But we're developing another 2 in the next 15 months, roughly. So we'll have developed 5 mines within the space of 5 years. And that's a pretty amazing effort. And it's a full credit to the team at Atlas. Another element or strategic perspective about the way Atlas has grown is that we've always looked to maintain a really strong project pipeline and looked for further options to grow. And this is where our Horizon 2 of growth becomes really important. We'll have a really solid business operating at 12 million tonnes per annum, strong balance sheet, good operating cash flows from the mines, and a fantastic option to grow our production rate well beyond 35 million tonnes per annum, in fact targeting our absolute port capacity at 46.5 million tonnes per annum. Now to do that, we need to stretch ourselves beyond the trucking model, because in reality the trucking model is capped, and it's capped in the range of 12 to 15 million tonnes per annum. So that growth makes sense, to grow to 12 to 15 million tonnes per annum. To grow beyond that, we need a rail solution. And we've been very active in discussion with many players, but in particular QR National for the development of an independent Pilbara rail network, and there is a chance that that's an amazing piece of infrastructure business for those kinds of people that are interested in it. At the end of the day, a QR type solution in the Pilbara could be delivering up to 75 million tonnes per annum of railed capacity to independent port capacity in Port Hedland Harbour. And that's a big piece of infrastructure business, and that's why a company like QR is happy to entertain the discussion with Atlas and our partners. Of course, we have regular conversation with the other people that you'd expect to be having the conversation with, perhaps with the exception of BHP Billiton, has more or less made it clear over their dead body they're not going to touch the Newman line. And as a result, you'd expect that we'd be having conversations with all the other players. And I would say that there is a new level of pragmatism, let's call it that. Pragmatism is emerging in the Pilbara in a way that historically, it would seem, it hasn't been able to. And that new wave of pragmatism is driven by, to a certain extent, you could argue, the inherent uncertainty in the iron ore price, and in particular the volatility of the iron ore price. You've only got to look at FMG's experience to appreciate why they might be now interested to talk about new ways of viewing infrastructure. And I'm sure you're aware of the general commentary that's emerged in the public domain. So that's Horizon 2. A bit about iron ore sales. There's just been far too much negativity about the iron ore space. Everybody got a little bit of a fright, let's call it that, in August, September, with the volatility that emerged in the iron ore price. But if you've got a solid balance sheet, if you've got the cash in the bank, then there is no reason to panic. And that was our feeling. Whilst we didn't like what was happening, our customers were still performing. Contracted customers were taking their ore in sequence, and they were establishing good credit in the way that they have for the last 2.5 years. We're selling 50% of our cargoes roughly under contract terms, and we're selling the other 50% in spot markets, typically amongst a select customer group. And the spot cargoes were attracting multiple bids. And yet, there's this all-pervasive negativity about what's happening in iron ore, and we couldn't reconcile it. We're sitting there selling our iron ore week on week. We've got a ship leaving roughly every 5 days, I would say, and the customers are lining up to buy it as they have in the last 2 years. Now, the price, of course, was falling off a cliff, and I guess that's the difficulty. That was the difficult bit for us to reconcile. But when you break it down, I think there is at least some logic as to why those events happen. And rather than dwell too much on it, let's just say it's basically the problems with quarterly contracts that are broken down. Those cargoes have to go somewhere, so they go into the spot market. If the market's already on a downwards cycle, it's going to accelerate. There were some problems with some of the steel mills and their financing activities, and the Chinese knuckled down with them. The traders themselves are part of the problem. Sitting on port stocks, at some point in time they'll capitulate. Those tonnes have to go somewhere, they go back into the spot market. So all of this contributes to increased volatility. Now, having said all that, in my view, the index pricing system is the right way to be dealing with the Chinese market. It's just that you have to set your business up to deal with more volatility. The volatility implies there will be problems to the downside, but equally there will be opportunities to participate in the upside. And we had at least some faith that the price was going to bounce back. Okay, in terms of what we actually sell, our regular product, 57.5% iron. We have a value fines product. We sell a low grade. The Indians have left the low grade market. In fact, the behaviour of the Indians has been probably one of the more important elements of the dynamic of late in seaborne trade. Having historically contributed 60 or 70 million tonnes to the Chinese market, they've now, in essence, left. And as a result, there's an opportunity for Atlas to participate in low-grade sales, and we're taking advantage of that. Those tonnes would have been mined anyway within our pits. So instead of going onto a waste dump, they go, in essence, for free to the crusher. And as a result, we still make a very strong margin on those tonnes. The spot market is deep. It is very deep. It is very liquid. To use Marius speak, it is a market clearing price. Every tonne that goes into the spot market will get sold, and it'll get sold at a price because the market is so big, so deep and so liquid. And in fact, we don't mind playing in the spot market. We'll continue to try and extract value by maintaining at least some spot sales, despite the fact that we'll grow our contracted volume. And I made the comment there at the end that there is substantial new demand. And this is intriguing because, again, if you believe the media and some market commentary, everything's negative. But I can assure you, in talking to our customer base, it's not. We are actively signing new term contracts now, and there is a new wave of urgency around those discussions. And to my mind, that's telling. That basically says the Chinese are looking to secure new supply for the medium term. And we think that's positive for the industry. We're also very active outside of China, and we are generating some success there. So as we move to a broader discussion, you've got the goose, you've got the golden egg, and it's precious, and it needs to be looked after. And I want to talk a bit about why it should be looked after. And I'm just going to focus on a graph here that I think is actually really important in describing the pervasive dynamic that is the structure of the iron ore industry, and in particular in seaborne trade. So here we're looking at a cumulative tonnes moving to the right of the graph delivered into the Chinese market, inclusive of Chinese domestic iron ore supply. And this picture tells what I think is a really important structural story about why we should all be very optimistic about iron ore in the medium term, and very optimistic about our iron ore industry as a whole, and for that matter, mineral and energy exports as a whole. What the graph tells you is that you have low-cost production delivered to China on the left-hand side of the graph, and you have high-cost production delivered to China on the right side of the graph. The reason this graph is important is it shows that the Chinese themselves deliver the highest cost production to their market. And there is no rocket science as to why it's expensive. It's expensive because they mine extremely low grade. It's that simple. They mine iron ore at 21% iron, and they beneficiate it, or they process it, to achieve a blast furnace feed grade, let's say north of 60%. And that is very, very costly. There's no way of avoiding that. It is what it is. It's expensive. And the Chinese were the best at expanding their production base during what historically might be perceived to be the boom years from 2004. They expanded their industry much faster than anyone else in seaborne trade, but they've done it at an extremely high cost, and it now constitutes a very large segment of the market. The red bars there, cumulative production, roughly 350 million tonnes of very high cost supply. And it would seem it's relatively elastic supply. So if the price in China is dropping, those mines are shutting down. And as a result, at some point in time, the market responds, the mines shut down, and there's a supply squeeze, the price comes back up. And again, with the benefit of hindsight, we can say that that's essentially what happened in August and September. Now, the reason we should be optimistic in the medium term talks to a bit more of the sort of macro theme as well, and that is, as 350 million tonnes per annum of supply to the market being high-cost Chinese domestic production, it is very difficult for other seaborne trade, and in particular lower-cost seaborne trade, to displace that high-cost production, and in particular, whilst there is still some underlying growth going on in the Chinese steel industry. Now, why is it difficult for the seaborne traders to expand? It's, again, very simple. Because all the easy mines are gone. All the easy railways are gone. All the easy ports are gone. Just about everywhere around the world. Everything that's left to be developed now is universally harder than the historical norm. So if you talk to the mines, what's being mined today is higher strip ratio. It's typically underwater, so it's being dewatered. It's wet ore, therefore it's wet processing. And in most cases these days, particularly the case in the Pilbara, it's being processed, it's being beneficiated. All of that translates to higher cost mines in capital and OPEX, longer lead times to delivery, longer periods of time to ramp up, and this is the clincher. The industry historically has always overestimated what's possible in terms of expansion, both in terms of underlying cost and the speed of new supply coming on. And that's not new news. The industry's been like that forever and a day. People are concerned about the new wave of production coming through, and clearly there is new production coming through. I'm not so naive as to expect that there isn't, but it won't happen as quickly as people expect for the reasons I've just described. It's hard. It's bloody hard to start these mines. It takes a lot of blood, sweat and tears. There's a lot of crying over your Wheaties that goes on to start these mines. They are tough. And as your business gets bigger, they're even tougher. If you're running a mine at 70 or 80 million tonnes per annum and you're expecting to get it to 150 million tonnes per annum, I can tell you that is twice as hard as doing it from 0 to 70. And that's just a fact of life. So people are overestimating the new supply coming through. That's why I'm optimistic that there is still plenty of opportunities and a niche for Atlas. The other thing that's important is just to reflect on Atlas's position in that global scale. We are a relatively low-cost producer. Today we deliver our iron ore to China for about $58 US a tonne, roughly. Vale does it for 55. So we are globally competitive by anyone's measure. And could you expect that the iron ore price fell to an equivalent position that threatened that $58 cost of supply to China? If it did happen, I can assure you it can't happen for long, because the industry can't be sustained with iron ore prices heading south of $80 US a tonne. It just doesn't work. The industry's got new benchmarks basically for its underlying cost base, and of course the Chinese are a key driver there. Okay. Oh, no, sorry. I've gone backwards, so they told me not to do that. I'm sorry, there's one other point I wanted to make. There was quite a bit of discussion, I think probably going back maybe 3 or 4 weeks ago now, where the Chinese were talking about lowering the tax base for their domestic mines, and it was in an effort to make their mines more competitive. The first thing I would say about that is that the mines have to be profitable in the first place for any tax change to be material. And I think you can see, as a result of that graph, there is a good chance that a lot of mines aren't profitable in China. So in my view, tinkering with tax environments in China doesn't change the fundamentals. Flaw is probably too strong a word, but the very fact that they're mining extremely low grades just indicates that they're not going to be competitive in the medium term, in which case there will always be high cost supply until it's displaced, if and when that happens. Another side comment: at the same time that the Chinese were talking about lowering their cost base, our government was talking about increasing it. Somewhat ironic, I think. When you consider the competitiveness of our industry, the lion's share of that global seaborne trade on the graph is Australian supply. Why would you nobble an industry that is so competitive? We should be celebrating it. We should be taking advantage of it. We should be encouraging new production. And in our own way, I'd like to think that Atlas can be an important part of that, of course, as well. All right, so just a bit of reflection on WA and its place in the world. I have a lot of sympathy for the view of our Premier, Colin Barnett, who says, basically, in WA, we have so much more to do with Asia than we do with the eastern states, we can almost forget that you guys are here. And without sort of wanting to inspire the whole secessionist debate, I'm not going to go there. In part, he's got a point, because the success of WA is now absolutely tied to China. So here, in 2012, we have China growing at let's say it's roughly 8%, probably heading to 9%, back to 9% next year. We have Western Australia growing at over 6%. And we have the rest of Australia growing at kind of 2.5%. If China sneezes, WA catches a cold and Australia gets pneumonia. It is absolutely crucial that we continue to support those areas of the mining industry that are ultra competitive, and of course iron ore is one of them. And that's why the Pilbara is always going to be a really crucial part of the Australian economy, let alone the West Australian economy. So here we're looking at energy and mineral exports. The top left-hand corner, you can see Western Australia dominates Australia's output. But the real point I wanted to make here was to say Western Australia dominates Australia's output, but the Pilbara dominates Western Australia's output in the bottom right-hand graph. And what it points to is the importance of, as a whole, of the Pilbara to Australia. And my view would be, in policy terms, it's dealt with, I think, relatively weakly. The significance of what's happening in the Pilbara is not being fully understood, let's put it that way. And there is a bigger opportunity there if we're prepared to grasp it and take advantage of our natural competitive advantages, and they are extraordinary. The Pilbara's endowment, its endowment of energy and mineral wealth, is extraordinary by any measure. And not only that, its proximity to those key Asian markets dictates that in many cases it will be the absolute lowest cost source of supply. We should be celebrating that advantage and maximising that advantage, not putting hurdles in front of industry as it's looking to take advantage of those significant wins. So in WA mining and iron ore, we're really just talking here about more of the strengths that the West Australian mining industry brings to the table. And in particular, I wanted to focus on the last bullet point there, in saying that there was, believe it or not, this statistic is pretty extraordinary, a new 24,000 people were employed in mining in WA in 2012, a 27% increase. And again, that just points to the very fact that we should be capitalising on our advantages. If there's an opportunity to transplant workers from the eastern states, if there's an opportunity to mobilise our workforce, we should be taking every opportunity we can. And actually, again, just as a comment off to the side, fly in, fly out, it has its place. Again, it's a bit of a case of horses for courses. But WA's experience, I think fly in, fly out, it gets overly penalised. There's basically a generation of workers in Western Australia now that have been living and breathing the fly in, fly out work regime. And people focus on the negatives. But when you work in the industry, you talk to many people. In fact, my own personal experience is, as a young guy, I thoroughly enjoyed it. It was an opportunity and it was something to be grasped. And yet, when we talk fly in, fly out, it has negative connotations, and I think it's unfairly criticised. Where I was going to go with this was to say, if there's an opportunity in fly in, fly out and it's been realised in Western Australia, we're mobilising the workforce, then we should be looking to do the same thing from the eastern states. Whether someone's jumping on a plane and it's 2 hours from Perth to the Pilbara, or it's 4 hours from Sydney, Melbourne to the Pilbara, really, from business's point of view, in a matter of speaking, it's neither here nor there. The question is, how do you attract people? How do you make them move? And that's what's got to be solved. Now, I don't have all the answers today. I'm just saying that if there's an opportunity, we should be looking to take advantage of it rather than deriding the opportunity, which is a lot about the public commentary that you hear today. There is clearly opportunities in fly in, fly out. All right, so again, just going back to Atlas. In our business, we are globally competitive. We've got a simple operating model, and yes, we operate with trucks, but it's a really successful business. And we are competitive into China. We've got a really strong balance sheet. The company's always had a very conservative view as to how we could grow, maintaining a strong balance sheet, having good liquidity, and that's served us well. It saw us through the global financial crisis. It saw us through the recent volatility in iron ore markets, and our board should be credited with that. We've got 3 new mines, they're running now. Pardu, Wodgina, Mount Dove. We've got 2 new mines under construction, that'll grow our production to 12 million tonnes per annum by the end of next year. We've got a really big Pilbara footprint, and that is a huge strategic advantage. 1.1 billion tonnes in resources, 414 million tonnes in reserve. And that's a significant piece of business. Atlas has always had a strategic advantage in infrastructure, and I can't stress enough how important that is, of course, in the iron ore game. We've had one eagle eye on infrastructure, we've had an eagle eye on resources, reserves and mine capacity. You put the two together and you've got an amazing business. I'd like to think that we're heading there today. And that's all I've got for you. Thanks very much.